Let's start with who I am. My name is Tim Linger, and I'm a certified reverse mortgage professional, CRMP, and that is our trade association's highest honor and designation. There's only 150 of us in the entire country that's been awarded the CRMP, Certified Reverse Mortgage Professional designation. So if I can brag about myself, I am an expert of experts. I'm one of 150 that's recognized. I'm also a certified senior advisor, have been for 21 years, and that makes me a master of nothing, but I like the title anyways, making a joke. Certified HECM specialist means that I understand the HECM program pretty intensively. Today's presentation is about the reverse mortgage, as most people call it. I call it a HECM because that's the legal name of this program. It is a HECM for home purchase in particular, but we're also going to talk about the HECM refinance. It's presented today by the HECM Association, which I'm the president of. The HECM Association's mission is to spread great information about how the HECM, the home equity conversion mortgage, works, and in particular, the HECM for home purchase. So let's start by doing this. What the heck, that's my little joke, what the heck is a HECM? A home equity conversion mortgage is the good kind, the safe kind of a reverse mortgage. It is the one that's sponsored and insured by FHA. The HECM for home purchase is like buying a home at half cost, half price. In fact, we have a website called halfcosthomes.com. And as realtors, for those of you that are realtors on the call, you have the opportunity to be on that website at no charge. It's a lead generation site. And that's sponsored by the HECM Association. So in a sense, this is like buying a home at half cost, or in your case, selling a home because you're realtors at half cost. So the question for the realtors that are in the room, today, if all homes were at half price for those who have cash, how many half cost homes would you sell? How many of those could you sell? And the answer is all of them, right? If a $300,000 home was on sale today and today only for $150,000, how many of those could you sell? There'll be people lining up for them. And that's what this presentation is about. This FHA mortgage is just like selling homes at half cost. And you can sort of relate it to sort of like a first-time home buyer. We call it lifetime home buyer. But a first-time home buyer is somebody that has not owned a home in the last 3 years, that wants or needs down payment assistance. And there's all sorts of qualifications, but basically some agency will provide grant money to help somebody with $5, $10, $15, $20, $40,000 worth of down payment assistance so they can buy their first home. Well, the HECM is sort of like that, except the government has a program, has a program they insure. We call it lifetime home buyer, lifetime program, where they will provide 50%, approximately 50% of the purchase price for a senior to buy their lifetime home. So let's get into some statistics. This program is available in every state of the United States: Alaska, Hawaii, Puerto Rico, and I believe the other territories like the Virgin Islands. I'm not 100% on that because I've never heard of anybody writing a loan like this in the Virgin Islands or America Samoa or Guam, but I would imagine they're available there. But in Florida, here's what's interesting, is 24% of the home buying population are age 62 and above. If you eliminate people that are under age 18, they don't buy homes, not legally. So there's a lot of people in Florida that are able to buy homes, and you can find these group of people anywhere in the United States. In fact, in Utah, as an example, not too many years ago, the #1 spot in America for people doing the HECM for home purchase was in some little town in Utah that a lot of retirees were moving to. And it just so happens that the realtors and the loan officers had gotten together and started promoting half-cost homes, and were selling more homes in this town in Utah than any other place in the United States. #1 hotspot. Now that's changed over the years. California, Carolinas, and Florida are big spots for HECM for home purchases. So let's move on past this screen, since we have people from all states here. But here's a fact. Currently, there's more than 10,000 people, it's actually 13,000 right now, of people that are in the baby boomer generation that are turning 62 years old every day. So whether you're in Wisconsin or Texas or Idaho, there's a tremendous amount of people that are turning 62. That's relevant because you must be at least 62 years old to be able to do this loan. That's the minimum age for a borrower. The spouse can be younger, but the borrower must be 62. So every state, you have people that are eligible for this by the tune of 10,000 people every single day, 13,000 currently. 77% of the nation's wealth is controlled by seniors, cash buyers. The reason I put that statistic in here is because I talk to a lot of realtors that just say that I only sell to people with cash. Most of my retirees have the cash. They're selling their too big, too large, too expensive home, and they're wanting to downsize, and they're paying cash. Well, that's what we're looking for. We want cash buyers. How many times have you taken a cash buyer to the neighborhood that they can afford? In other words, if they say to you, I have $200,000 cash, sell me a home. Now, what's the first thing that you think? I'm having a closing next week, right? I'm having a closing next week. But you take them to the $200,000 neighborhood, and it's not really what they were expecting. They wanted the golf course home. They wanted the pool home, the jacuzzi home. They're wanting a single story home. It's interesting that the house they really want is $250,000 or $300,000. So now what do? You put them into a mortgage in retirement. They're 62 years old, and they're getting ready to enter into a 30-year mortgage. They're going to be 92 before they pay this thing off. And what's going to happen in those 30 years? The spouse is going to pass away. They're going to have some health issues. They're going to have some expenses they weren't expecting. They're going to have home repairs. Even if it's a brand new home, eventually the roof will need to be replaced, the air conditioner, the heating source. There's going to be things that's going to come up. One thing that's for sure is their income is not going to increase by much, but expenses will, especially if a spouse passes on. So I often say is don't let a senior get a mortgage in retirement. Don't let a senior pay all cash for a home. And that's what this program is about today. We'll get into it in more detail. 86% of seniors, regardless of the state they live in, want to age in their own home. And you could say, well, duh, but it's interesting. There are some people, 14%, that would actually like to move into a retirement community. The problem with homes is a lot of them are 2 stories. A lot of them have steep driveways. A lot of them are not conducive for a retiree, somebody who's aging, especially stairs. That's the biggest one. How many people have seen stair lifts in someone's home? What is a reverse mortgage? One thing we have not done yet is we have not called this product a reverse mortgage. The legal name is HECM, Home Equity Conversion Mortgage. There are many, many types of reverse mortgages out there. I like to compare it to fruit. A reverse mortgage is a generic term. It's a category. It's sort of like fruit. There's all sorts of fruits. There's limes, there's lemons, there's grapefruits, there's strawberries, there's grapes. There's sweet fruits and nasty fruits. Well, if you want to call grapefruit nasty, let's call it sour. And yes, they're all fruits. So reverse mortgages, there's multiple types of reverse mortgages. There's good ones, there's bad ones. But the HECM is the good kind. Why would somebody do this kind of a loan? Payments are optional. I said earlier, mortgage is a mortgage, right? But a lot of people will say this is a no payment mortgage, a no monthly payment mortgage. A lot of people say this is no payments. A lot of people have that misconception. This right here is a no required monthly payment mortgage. No required, i.e. optional. So if a person does not make a payment, which they usually don't, the balance is going to go up every month, right? If they don't make a payment, the balance is going to go up every month. But that's their decision to not to make a payment. By not making a payment, that gives them more spendable money for retirement. Most people don't make a payment because, well, why? Let the balance increase. It doesn't matter if I live in this house the rest of my life, I'm never going to have to pay this loan back. My heirs will. And then some people say, well, eventually the bank's going to own the house, or eventually I'm going to owe more than the house is worth because the interest is just going to keep accumulating. Well, here's, if anybody's got a pen and paper, write this down. It's easier to see it in black and white. If a person purchases a $300,000 house, and depending on their age, let's say their down payment is $150,000. We're going to keep things simple math. We're not going to do compounding. We're not going to factor in the closing costs. We're going to just do simple math here. If a person purchases a $300,000 house, and let's say the math works out that they're putting $150,000 down, which means they're going to finance $150,000. Their loan balance will be $150,000. They're going to put $150,000 into it, which means they have equity, and they have a $300,000 house. Everyone with me? Let's say that the interest rate is 5%. By the way, the interest rate currently is around 3%, but let's just say it's 5% because I can do that up here. Interest on $150,000 at 5% would be $7,500 a year in accumulated interest if a person chooses not to make a mortgage payment. If they choose not to make a mortgage payment, then next year they're going to owe $157,500. Okay? So hopefully everyone's with me. Now, the home is supposed to increase in value. FHA says going back 100 years worth of their statistics, homes have averaged approximately a 4% increase in value. Now, maybe in California it's 9%, maybe in Florida it's 7%, maybe in Alabama it's 2%, but on average, homes increase at 4% a year. 4% on a $300,000 house is $12,000 worth of additional equity that's growing every year. Not every single year, but on average, homes will increase at 4%. So if the home increases at $12,000, but the debt increases at $7,500, that means there's more equity in the house every year than there was in the previous year. That's the way things are supposed to work. That's the way FHA designed this program 30 years ago. That's the way it has worked out in most years, less the housing crisis. So the house is not going to go upside down. There will be equity in this home for your borrowers or for the borrower's family in most situations. So that's the good news of this program. Additional good news is this is a non-recourse loan. What does that mean? That means what if what I just said doesn't happen? What if someone did this HECM reverse mortgage in 2005, 2006 at the height of the real estate market, and then they were done with the house, meaning they decided to sell it or they passed away in 2009, 2010, 2011 at the bottom of the real estate market? That could happen, right? This $300,000 house could be worth $150,000. If they borrowed $150,000 plus interest, maybe they owe $200,000. So let me say this one more time. Something bad happened. The house is worth $150,000, but your clients owe $200,000. And now they're done with the house. The non-recourse feature of this program kicks in and says to the family, to your borrowers, that they cannot be hurt by an FHA HECM. The non-recourse feature will make up any losses. If the lender were to fail, if they don't honor the contract, if the house goes underwater, if there's a problem with this loan, FHA's trust fund, which is financed by borrowers of HECMs, will bail the estate out. This is the safest loan in America. If the house goes up in value, you win. If the house goes down in value, your clients win. So let me say one more thing and I'll open it up to questions. The FHA HECM that I'm referring to, today's class is about the purchase program. We're realtors here, we want to sell homes. We make our commission, you make your commission off of selling homes. Loan officers make their commissions by doing loans. So whether we do a refinance HECM or we do a purchase HECM, the math is the same. It's either 50% going in or 50% coming out. All right, questions?
With the home purchase, the FHA is going to give the buyer 50% of the loan value, is that?
For simple math, yes.
Okay.
So if the house is worth $400,000, depending on a person's age, FHA might be willing to lend around 50% of the value.
And the refinance of this type of loan of the HECM, does that also work if someone's in a regular FHA loan and they could refinance to a HECM?
So person has an existing loan, it doesn't matter if it's FHA, VA, conventional. If a person owns a house, they have to be 62. It must be their primary residence, and they want to maybe pull money from it. So let's use a value of $300,000. That's a good round number for me. Let's say you have a 70-year-old that with a $300,000 house, and they want to refinance it. If it's paid for, the math works out to around $150,000. Again, the value of the house, along with their age, we come up with a mathematical figure, and it runs around 50%. So if they are living in a $300,000 house as their primary home, they can borrow $150,000. If they don't have a mortgage, then that's the kind of money that's available to them. If they do have a mortgage, well, that's still the same amount of money that's available to them, except we have to pay off the mortgage first. So let's say they have a $100,000 mortgage. They're entitled to $150,000. We got to pay off that mortgage first, which will give them the other $50,000 for their retirement.
Not bad.
So let me recap what I just said, because then hopefully in my recap I'm answering your tough question you had in the beginning. And for those of you that came in late, Chandra said that she is also a notary and she closes some of these loans, and sometimes she scratches her head and wonders if they really know what they're getting themselves into. So I'm just going to recap what I just said, and if I don't cover your total question, Chandra, then please ask me another question to complete that. This is the safest loan in America. It truly is. You can't get hurt if the housing prices go down. You can't get hurt if the housing prices go up. Payments are optional. You really have two choices when you're in retirement. You can get a mortgage, 15, 20, 30-year mortgage, and make a mortgage payment, required mortgage payment for the rest of your life, 30 years, or you can get an optional mortgage payment. And I think everyone in this room, if you had a choice to have an optional payment or a required payment, why would anybody want a required payment when you could just make payments that are optional? So you're able to borrow money at a super low interest rate, currently 3%, without having a mandatory payment. And if you want to make a payment, then you can. And if you do make a payment, the money goes into a line of credit. It's just like a home equity line of credit that you get at your local bank. If you do decide to make a payment, it goes into your line of credit. The money actually pays down the balance, like all mortgage payments do, but also goes into a line of credit, which means that sometime in the future, you decided that you needed that money back. The FHA program, the HECM, will actually allow you to borrow that money at no additional charge. In other words, you're borrowing it from yourself, right? Because it's your home. But let's say you made a $10,000 payment last year because you could, and then this year something came up and you realized that, well, maybe I shouldn't have made that payment. I wish I hadn't made that payment. Well, you can just call up the servicer, your client can call up the servicer and get that money back at no charge. Three things that determines the down payment amount. I like to say half cost homes, I like to say 50%, but it's not totally accurate because there's three things that make up that number. First of all, the home's appraised value, the person's age, the younger person's age. So earlier I said you had to be 62 to do this loan. That's the minimum age to be a borrower. There is no maximum age. You could be 100, 110, but you have to be at least 62. The spouse, keyword spouse, can be of any age, all the way down to age 18, but they have to be married to a spouse. They have to be married to, they have to be married to a spouse. Of course they do. They have to be married to someone who's 62. So we always base on the youngest person's age. So it's not uncommon to have a 62-year-old married to a 55-year-old. We're going to use the 55-year-old's age. So once again, how do we determine the down payment amount? It's the value of the house, the youngest borrower or non-borrower's age, and it's the interest rate. The lower the interest rate, the more FHA is willing to lend. The higher the home value, the more FHA is willing to lend. And the older a person is, the more FHA is willing to lend. Age has its benefits. Now I'm going to show you a chart on the next screen that gives you some numbers to sort of digest. Now some people say, well, what's the average age? You know, I have a lot of customers in their early 60s, a lot. but the average age nationally is 72. I've had realtors tell me, well, seniors, that they don't buy houses. Yeah, they do. A lot of seniors buy houses. In fact, a lot of seniors will buy 2 houses in retirement. They'll sell their too big, too large working home, and they'll downsize into a home that they think they're going to like, and then they realize the house is too small. People don't really want to downsize. They really want to upsize. I'm not saying upsize as in a big mansion. I'm saying upsize. They want the extras. They want the swimming pool, the jacuzzi, the golf course, the lake, the riverfront. They've worked hard in their life, and they want a nice retirement home. And sometimes they think this is what they're supposed to get, and they wind up buying a second home. So we're going to show you some ways of how you realtors can increase your sales by using this program. Get a listing, sell the house, and help the retiree into a second house. Now digest this chart for a moment. I have a slide like this for every home value from 200 all the way up to $1 million, but I'm going to just show you 3 of them today. Now let's start with age 62. The down payment for a 62-year-old to buy a $300,000 house, including the closing cost, is approximately 53%. So the rhetorical question of the day, I'll ask for the second time. If you have a 62-year-old borrower who has $159,550,000 in cash, and they say to you, I want to buy a house cash money, you're excited for a moment, but now you realized that you can sell the same house, the same borrower, a $300,000 house for the same money. How many homes could you sell? How many $300,000 homes could you sell for $159,000, right? Now, the catch is they have to have the money. They cannot borrow money to borrow money. They have to have the $159,000 cash. And where are they going to get the cash? They're going to get it from their previous home sale. They're going to get it from savings, from inheritance, from 401k. They're going to get it from somewhere. But that's the requirement. You have to be 62, buying your primary home. You have to have the cash money, $159,000 for a $300,000 house. Now, as they get older, age 67, age 72, age 77, age 82, look how much the down payment comes down. How many $300,000 homes could you sell to 82-year-olds for $121,000? Once again, this includes the closing cost. Now, the lending limit, if you notice here, I changed the value at the top, 765, 600, the very top of the screen. The lending limit is 765. What does that mean? That means that for any home that's $765,600 or lower, we will do this math. Age 62, it's approximately 52%. Down payment's $397,000. If they wanted to buy a house more expensive than 765, they can, but every dollar above 765, they have to come up with it dollar for dollar. So in other words, if they wanted to buy an $800,000 house, they'd have to come up with an additional $35,000 because that's the difference between 765 and 800,000, plus the numbers on your screen. And just for the fun of it, let's show you $1 million house. An 82-year-old can buy $1 million house for $528,000. How many $1 million houses could you sell to 82-year-olds for $528,000, right? How many people, you don't have to raise your hand, but it'd be interesting if everyone raised their hand. How many people think the 82-year-olds don't buy houses? That's a false. Because when is the end of life? We don't know. I have a lot of clients that are 99. My oldest client's 106. And they're buying homes. 93-year-olds buying homes. I have a 92-year-old right now buying a home, not refinancing, they're buying a home. And typically they don't downsize. They may want a maintenance-free lifestyle like a townhome or a condo or something where there's less work. But rarely do my clients downsize. They may right size. They may get a home that's more suitable for them in a better neighborhood. Questions?
So what we're looking at in terms of the closing costs, percentage-wise?
All right, I love this question. I didn't even put it in my presentation because it's always a question. I've been doing this loan for 20 years. It's been around for 30 years. The purchase program, by the way, has been around for 10. And there is absolutely nothing wrong with this program. Most people, when they when they learn about this program, when they stop and listen, they leave the program loving it. A lot of naysayers out there until they understand it. So your question is what about closing costs? I tell you one thing, if you have to pick on something, closing costs. This is not a cheap loan to get into, but then again, it's actually the cheapest loan. And the reason is because there's no mortgage payment. I'm a believer that if there's a negative, there's probably a positive. If there's a positive, there's probably a negative, especially when you're dealing with a program coming from a good agency, in this case, the federal government. The federal government is not in business to hurt us, and don't answer that question. The federal government is not in business to hurt us. They've come up with this program to help the citizens of the United States. In fact, let me stop myself. Anybody who's in this country legally, if they have a Social Security card, can do this loan. They do not have to be a U.S. citizen. Let me correct that real quick. They have to have a Social Security number in order to do this loan. They do not have to be a citizen. So closing costs. So first of all, you have your third-party fees. You have your doc stamps in Florida, intangible tax in Florida. You have recording fees, title insurance, maybe a land survey. Every state's different, but you have all those closing costs that go with mortgages. If you're getting a mortgage, it is what it is, right? Then you have the lender's fee. Now, some people call it points, call it what you want to, but lenders, especially in the HECM, need to charge what we call an origination fee. You could call it points if you want to. We call it an origination fee of anywhere from $2,500 up to $6,000, the maximum. Now, we could eliminate that origination fee by increasing the interest rate, because lenders have to make their money either by charging a fee or charging a higher interest rate. Lenders have to pay their processors, their commissions, their underwriters, and overhead, right? So if you remember before, the three things that determine how much money a person is eligible for is the home's value, the youngest person's age, and the interest rate. If they can get the interest rate as low as possible, then the amount of money FHA is willing to lend is higher. So it's the broker's job, it's the lender's job to get the interest rate as low as possible. The way we get the interest rate low is we charge an origination fee. Some people will look at closing costs and say, whoa, that's a lot of money. It is, but there's no monthly payments. So it actually becomes a cheaper loan over time because you're not making a mortgage payment, or optional, not making a mortgage payment. So far we've discussed two of the three fees. So we have the origination fee of upwards of $6,000 depending on the value of the house. We have third-party closing costs, and you realtors can figure that out, what the closing costs would be for your area. And then you have the FHA fee. Now, in my opinion, that's what makes this loan expensive, at least appear to be expensive. So FHA charges 2% of the appraised value, not the lending amount, not the amount that's being borrowed, but 2% of the appraised value, up to $765,000. So let's go with this huge number right now. Your client is buying a $765,000 house. FHA is going to charge 2% of that number, which is approximately, quick math, $15,000 in just FHA fee, a one-time upfront fee of $15,000 and some change to insure this loan, to promise to your client that if the house goes down in value, that your client and the client's family cannot be hurt by a situation where the loan balance is higher than the house's value. Or if the lender were to fail, FHA steps in. They charge a fee to do that. So you got $15,000 from FHA in this value. You have maybe a $6,000 fee from the lender. Now we're at $21,000. And then you have your third-party closing costs, which is going to vary from state to state. But in Florida, it would be about $10,000. So on this particular purchase, it would be a $31,000 in closing costs. But remember what I said earlier, the number I'm giving you here on the screen includes these closing costs. So if you have a 72-year-old client and they have $354,000, they're buying a $765,000 home. And as realtors, your commission is based on the $765,000, not the $354,000. If someone came to you and said, I've got $354,000, sell me a home, right, now you know you can take them over to the $765,000 neighborhood, including closing costs. Now, immediately, they're not going to be making a mortgage payment, so this is where the loan starts getting cheaper. The longer they have this loan, the cheaper it becomes. Now, if we were to go down to a $300,000 house, just so we're not doing a sticker shock situation, the closing costs on this would be approximately $5,000 from the lender in order to buy down the interest rate, approximately $6,000 by FHA, not approximately, exactly $6,000. Now we're at $11,000 in closing costs, and then you have your third-party fees, which might bring it up to $15,000, $16,000 in closing costs. But once again, closing costs are rolled into the loan, come out of your client's pocket. It's something that the house is going to pay for in the future. Next question. Anybody?
Yes, Tim, I have a question. So at some point, doesn't it make, it makes financial sense too in terms of managing your money and a financial return, like as compared to putting your money in a savings account or investing it in other. So if all things work to the positive, the property increased 4% every year and et cetera, and you never made a payment, you'd still have quite a bit of equity left at the end of the day, right?
That's correct.
Because I've worked it out, you know, like if I'm working with a 78-year-old, I've kind of figured, you know, like they maybe have another 15 years, let's say, to live. And if every year they had to pay that, what was the figure you were given? Like it turns out, depending on the price of the house, it's $12,000 a year in interest, right? You
Right. Could be.
add that all up, they're still in better shape from
That's right.
what they could earn at a bank, right? For example.
Well, you know,
Am I wrong?
no, you're exactly right. I had a client told me one time that they can't take anything with them. You know, if they die a millionaire or they die broke, there's nothing going with them. The number one thing in retirement is cash and cash flow. It's cash and cash flow. Or there are two things. Most important in retirement. People say money's not everything. Well, truly your health is more important than anything, but try living without it. Interest rate is so low, and it's expected to be low for the next 10 years. I kid you not. So using other people's money can actually increase your wealth. If you sit down with a financial planner that understands the HECM, and by the way, as you notice, I'm not saying the word reverse mortgage because you got to get reverse out of your language. There's too much negativity about reverse. Let's call the fruit that it actually is. Let's call it a strawberry. Let's call it a peach. Let's not call it just a general term like a grapefruit. Let's call it HECM because that's what it is. If someone says, well, that sounds like a reverse mortgage. Well, yeah, it is. It is a reverse mortgage. It is a type of fruit. It's the good kind. So that's number one I would recommend for realtors. But going back to your question, financial planners that understand this program, when they plug it into their financial planning software, they realize right away that the only way to make your financial portfolio last until you're age 95 or better is to include home equity. I'm not saying everyone should do a HECM. What I'm saying is that you have to factor in home equity into a successful retirement plan. Otherwise, you have to start cutting back on things that you don't want to cut back on, whether it be visiting the grandkids or traveling or getting that nice car or re-roofing your house. You have to include home equity. The problem with every other home equity kind of release program, such as a home equity line of credit or a mortgage, is you got payments. This is the only program that allows you to maintain the title of your property, own it, and not have any required mortgage payments. So some financial planners will recommend that a person does this right away. At age 62, go ahead and do this program, extinguish a mortgage, and let it sit there and in the line of credit for a rainy day. FHA has a built-in inflation factor into the line of credit. They grow it at about 3.5% a year. So if your client does this early on and they have $100,000 in a line of credit, FHA will give them a 3.5% growth on that money. In other words, they'll have $103,500 next year to spend if they needed it. And if they don't touch it, it just compounds. So there's some built-in financial planning factors into this. So whether they do it early or they do it later in life, home equity must be considered. You just don't know if a spouse is going to pass. You don't know if there's going to be a long-term care situation. You don't know what's going to happen to the economy, the housing market. You don't know what's going to happen to, values of stocks. You know, some are, the economy is booming right now in many ways, not every way. And it's predicted that it may not be doing so good next year. And who's to say, right? None of us have a crystal ball. So advertising homes for half down and no monthly mortgage payments and no required monthly mortgage payments will increase your call volume, thus more sales. You know, get the phone to ring. Let yourself be the local expert on the realtor side of the HECM for home purchase. But let me say this, do not be an expert on this loan. What we're trying to accomplish today is for everyone to get excited. The great Brian Tracy, which is sort of like a Tony Robbins in a whole different category, said to me once, I was in the audience, that sales is the transfer of enthusiasm. So I want all realtors to be enthusiastic about this program. I want you to love it. I don't want you to be an expert at it. I want you to know enough to get someone to say, yes, I'm interested in learning more, and then pass them on to a loan officer. Find yourself not only a HECM loan officer, but a HECM for home purchase specialist, somebody who actually has done these on multiple occasions, not just somebody who could do them, somebody who understands the purchase. Because what we have here is a HECM for refinance and a HECM for home purchase. It's like a coin with two sides. It's the same coin, but they're two different programs. A home purchase, you're putting money into a house in order to borrow the other half and to own it. And with a refinance, you have to already own it, and you're pulling money from the house. So it's the same coin, but it's two different sides. So find yourself a HECM for home purchase specialist, and you align yourself with them. So that way, when you refer your clients over there, they can transfer that enthusiasm to them and help you sell the house. So I typically say, I promise you, realtors, that I will not sell your home if you promise not to sell my loan. And take that to heart, because you don't need to be experts at lending, and I don't need to be an expert at being a realtor. So we do have CEs available in Virginia and Florida, just FYI. Currently, we're not charging for them. When we do charge, they're $10 a piece. We have a 2-hour class is our most popular one. The HECM Association is a nonprofit. So as a member of the HECM Association, which is also at no charge, we're not selling anything here. If you were to take a 2-hour class, whether you get the credits or not, you're eligible to take an exam to become a certified HECM specialist. And this is available in any state, by the way. You're only able to get 2 hours of CE credit, once again, in Virginia and Florida. You're also eligible to be on the halfcosthomes.com website. There's no charge for that. Again, our mission at the HECM Association is to spread the proper education about the HECM loan that FHA offers. And we currently don't have a membership fee for the HECM Association, and we have marketing support for people that live in Virginia and Florida. So you want to separate yourself from the competition. You want to be the expert in the room, the expert in your community. You want everyone to know that you know what you're doing and you're the best. Let me open up the questions. If you haven't asked one yet, please do. Ask me a tough one.
Tim, it's Chandra again. So it's not a question, but I just want to, I guess, make sure I understand this, because it seems like I've been working with a lot of seniors lately, and one got qualified for, I think it was an FHA loan, but they didn't want to put that large amount down payment taken out of their retirement. So this sounds like this would be a really good option for them. And you were saying that the fees, the down payment and all that stuff is rolled into the loan?
Correct. So this house, for an example, is $142,000 for a 72-year-old. The closing costs on this loan might be $15,000, but that's part of the $142,000. So I know it wasn't a question, but let me tell you what I would tell somebody who said, if they have the money, that's the key. They have to have the money. They cannot go out and borrow $142,000. They have to have the money from their own accounts, from the sale of their home, or from a family member or friend. So that's the requirement. They have to have the money. If they have the money, but they don't really want to part with it, and I get it, then they're getting ready to enter into what most people do, a 30-year mortgage. So they're either going to pay it now or they're going to pay it over time. The problem is they really need to think about this as a financial planning kind of a concept, because they're going to pay for it over time. And they could say, well, we're both 65. My wife is healthy. I'm healthy. We have good income. We can afford the payments. We got qualified. We want to put 20% down. And that's fine. If that's their plan. Your job is to sell houses, not loans. But on a moral and ethics kind of thing, they're going to start paying out $1,500 a month in mortgage payments for the next 30 years. What's going to happen in 30 years? A spouse is going to die. A spouse or yourself are going to wind up needing some kind of long-term care. There's going to be some financial challenges popping up. Maybe a new car. My gosh, they're $30,000, $40,000 nowadays. A new roof, $10,000, $15,000 or more. Right? Things are going to come up that's going to hurt their cash flow. So yes, it's a big nut to swallow, $142,000 in this example, but it's a one-time payment and no required mortgage payments for the rest of their lives. Not 30 years, but the rest of their life. One of my loan officers said to me one time, I love the phrase, there's something to be said for a roof over your head. Think about that. They're in retirement. They're 88 years old. They've lost their spouse. Their income has been reduced. They have to pay their homeowner's insurance, their property taxes, but there's no required mortgage payments. There's something to be said for a roof over your head. Next.
Tim, so
Yep.
if you took that philosophy another way, let's say the client is wealthy, right? They have enough money they could buy the $1 million house cash, and
Sure.
and they can afford to live till their whatever age. So is there still a recommendation there that would say that they should take advantage of this option?
Yeah. Here's what I would say to somebody with $5 million. Let's up it.
Let's go the other way.
Let's go the other way. They have $5 million, right? They're living in a $500,000 house, and they have $5 million sitting in the bank. And let's say $1 million of that's in qualified accounts, meaning that they've never paid taxes on it. They've got, $1 million in real estate investments, whatever it is. They've got $1 million in stocks and bonds. They've got $1 million in whatever. They've got their money placed where it needs to be placed in order to minimize taxes and maximize return on investment, right? Everyone's got their money where it needs to be. And if they don't, then they need to talk to a financial planner, right? Something happens. They need $100,000. They need $500,000. Something comes up, right? Life is life. By having a home equity line of credit, a HECM line of credit, now they've got standby money. On a $500,000 house, depending on their age, they're able to have $250,000 sitting there that is not being charged interest because they haven't borrowed it. And if they do need it, well, it's because they needed it. And if they needed it, the last thing they need to do is have to make mortgage payments, right? They're sitting pretty. They have $5 million in net worth. They have a $500,000 house. They're sitting pretty. They shove their nose or stub their nose saying, I don't need this. Well, I disagree, because a good financial planner will say, let me tell you why. If you do need the money, there's no required payments. If you don't make any payments, then the interest is only 3%. If you don't have to touch the qualified money, or you don't have to sell stocks and have to pay capital gains, and you don't have to do this and don't have to do that, leave the money where it needs to be to minimize taxes and maximize return, and use this tax-free money from your home equity, then your net worth will actually increase. I'm a fan that unless you're just so rich, 10, 20, 30, 40 million dollars, I'm a believer that everybody that is age 62, regardless of their net worth, needs to consider this loan. I'm not saying everyone needs to do this loan. What I'm saying is everyone should consider this loan as part of their financial plan. Next question was, you said earlier that this has to be their primary home. And what does that mean, primary home? 6 months and a day? No. Primary home means that you're calling it a primary home. And what makes your home primary? Now that is a key. It must be your primary home. So remember that. A person cannot use this program to buy an investment home. It must be their primary. But in Florida, we have a lot of snowbirds, and they may live up north 8 or 9 months of the year, and they may come to Florida for just 3 months. That's okay, as long as they call their HECM home their primary. So once again, what makes it their primary? Maybe it's the fact that they vote there. Maybe they file their taxes there. Maybe they have homestead there, driver's license there. Maybe they register a car there. They pay their car insurance there. None of those things make it your primary necessarily, but one or more of those things can prove it's your primary. A lot of people have thought the process that the bank owns the house and there's no money left to be had for anyone. And we've already discussed that, and that is completely not true. Chances are there's a HECM will actually increase a person's net worth, will definitely help them in their financially in their retirement years. It gives them more disposable income and will probably give them more home equity in the future than they had when they started with the HECM and not having a mortgage payment. The interest rate, explain how the interest rate works. The most popular interest rate is an adjustable. The current rate is 2.83% as of today. The expected rate is 3.07% as of today, meaning that FHA thinks it'll average around 3% for the next 10 years. We do have fixed rates available. They're in the 4.5% range. But remember what I said before, the lower the interest rate, the more funds that are available. So a fixed rate is okay because it's fixed. I love fixed rates, but currently the adjustable is the most popular, mathematically speaking. It's the cheapest. And if the prediction, FHA's prediction is correct, a 3% average over the next 10 years sure beats 4.5% average over the next 10 years. If a person has substandard credit, can we do this loan? Yes, we can. We do not have a credit score requirement. We have a credit report requirement and an income requirement, but we don't have a debt to income ratio. I know that was a lot to digest. We pull the credit report. We're going to look at how they've been paying their bills. Are they responsible? We look at their income and do they have enough income to be able to pay their property charges and their credit report expenses? Do you have a car payment? Do you have credit card payments? What do you have on your credit report that we're going to add up? And then you're going to buy this house. What are the property charges, the taxes, homeowners insurance, homeowners association? We add up all those bills together and we look at the income. Is the income sufficient to be able to afford all those bills and still have about $500 a month left over to buy groceries? So we don't have a debt to income ratio, but we do have a ratio that a calculation, we call it a financial assessment.
I ran into a situation where a lady ended up having a husband that found a new thing, decided to run off and leave her with all the bills, including the entire mortgage. And she was in tears and told me flat out, just sell the house. I'm going to have to move to an apartment or my kid's house. And so the more I looked at the situation, because the husband pretty much said, I just want the other woman, you can have everything else, I was able to put her into a bigger house, a newer house, and a house she loved in the Villages for the money that she had sitting in the house that we sold, because they had some equity there. She didn't want to keep it because of the emotional stress. And I think there was a little bit of digging that said, hey, I want a bigger house, showing that I'm okay. And it worked out fabulous, and she loved it. And she just last year sold, and she had no problem selling. And we have enough appreciation that she did fine with it. So there's a lot of reasons, because like Tim said, you never know if that spouse is going to pass away, the spouse is going to end up in the nursing home where you're putting $6,000 out of your pocket every month, or if a situation where the divorce happens. So don't have your money all tied up in your house.
Very good. Thank you, Debbie. And that reminds me of a story, if you have time to listen, everyone. I think it's a great story. It was around 2010 as well. At the time, I was working for Wells Fargo in the reverse division. And the branch manager came to me and said, I've got a referral for you. He's a longtime friend of mine. I've done several mortgages for him, and he is getting a divorce. He's 67. His wife is around 67. And one of them has to leave, and the other one's going to get the house. So she said, so he called her up to get a mortgage, and she said to him, so let's just call him Jim. So she said to Jim, you need to look into a reverse. And he's like, hell no. Can I say that? Yes. He says, no, I'm not doing the reverse. They're nasty. I've heard bad things about them. Not doing it. And she had a really good relationship with this guy. And she says to Jim, I would never steer you wrong. I want you to come in and listen to my reverse specialist and just listen to the facts. Open ears, just listen. And at the end of the presentation, if you don't want to do a HECM, then I'll do a regular mortgage for you. But that's my requirement. If you want to do business with me, you have to listen. So I say that to you as realtors because you really need to be that adamant with your customers, because this is going to change their financial life in retirement. The HECM will change their financial life. I know we all want that sale next week, but we have to do what's right by the client. Sometimes the clients want to do this and not listen. So here's the fun story. I'm going to bring down my camera a little bit. So I walk into the conference room, and this guy is sitting. Jim is sitting on the other side of the conference table. He's like this, all right? He's got his arms folded. And you know that's not a good sign. He's not even willing to listen. But he says to me, Toby, that's her name. Toby says, I have to listen to you. I'm telling you right now, this is a quote, by the way. A reverse mortgage is a pact with the devil. That's what he said to me. A reverse mortgage is a pact with the devil. I said, all right. So I sat down in my typical smiling face, upbeat attitude, and I explained the program to him. And he sits back. He was doing this, and now he's doing this with his hands open at the end of the table. And he said to me at the very end, 45 minutes into it, he says to me, Tim, I realize now that this is actually a gift from God. Right? I hope everyone in this meeting has realized that this is truly an amazing program, a gift from God, if I can be religious for a moment. So here's the rest of the story. The original plan was his wife was to leave and he was going to stay in the house. But after he realized that he could buy a home at half cost, he moved over to the Tampa side of Florida, the west side of Florida. And this was 2010. It may have been 2011, actually. Homes were at the very bottom of the real estate market. He bought this really nice 3-bedroom, 2-bath home for $40,000. Using a HECM, he paid just over $20,000 for this house. Now it was a $200,000 house that he left. He got $100,000 cash and moved west and got himself a $40,000 house for just over $20,000. He got to put almost $80,000 in his pocket for retirement. He's living in a house with no required mortgage payments that today is probably worth, fast forward 9 years, it's probably worth $170,000 today. Now, it just so happens he bought it at the right time. But the fact is he got to keep $80,000. His net worth is higher. His ex-wife, is living in the house that they divorced in. She's been living there for another almost 10 years with no required mortgage payments. She got rid of the husband, right? She got rid of the husband without having to make a mortgage payment for the rest of her life. Because that's what divorce does. The wife would have had to get a mortgage to buy off the husband, and she'd be making a mortgage payment every single month for the next 30 years. So this gave her peace of mind. She got to stay in the house. She has no required payments. She's fine financially. The husband is even better financially because he got a heck of a deal. And that's one of my better pact with the devil stories. And that concludes the HECM. Sincerely appreciate, how much do we spend? 1 hour of your life. I appreciate this. I hope you appreciated the education. And if you're in Virginia or Florida, here's one of the flyers that we use to advertise half-cost homes. This is what you can do to exposure, getting people to call you. Hey, how can I buy this $250,000 house for $130,000? If you want to call me, there's the phone number. I don't think that's my direct number, but it'll get to me. And Chandra, got it. If you have any questions, especially as you had a really, really good question in the beginning, hopefully I was able to ease your mind knowing that you're helping someone get a better life, they shouldn't be concerned about doing the wrong thing because you're truly helping them. But if you haven't been convinced, I'd love to talk to you offline.
Yes, absolutely. I do plan on giving you a holler.
Okay, and if anybody's got a pen, you can write this down. My cell phone number is 321, area code 321-356-9229. 321-356-9229.
Tim
Okay.
also has a class that he does on Wednesdays. And so if you're interested, give him a call. You can hear it again. The more that you hear it, the more you'll understand it, and the more you realize it's really a good deal for most buyers. I say most because there's certain circumstances, no. But it's the thing that what I use it for in the villages is primarily the fact that somebody shows up with 200,000 in cash from their house sale, and then they turn around and figure out that 1,100 square feet house is not what they're looking for. And so I put them into that 300, 350, and they still have money out of that 200,000 to invest in another place. And then they turn around and get the house they really want.